This is part three. I believe my wife, my partner in crime, put up session number two, where we basically dove into how we go about selecting areas that we are going to invest in, right? Here in part three, we're going to have a conversation about the underwriting that is necessary to know whether or not if a deal pencils out. So I always have to start with this little disclaimer that says, you know, you can't sue me. I'm just an investor, in my personal opinion, and not a financial advisor, attorney, or accountant. So you, if you're going to move into any financial situation, I would advise that you consult with your own professional before making decisions. Code of ethics. On this meetup, we do not accept any money from any sponsors or platform for anything, including postings, reviews, referring investors, affiliate leads, or advertisement, right? What we're doing here today on this meetup is we're just going to have an honest conversation about how to invest in multifamily syndications. All right, we have the legalese done. The agenda for today is the deal analysis, right? We started out with using a Michael Blank spreadsheet, but we have since transitioned over to using the Adventures in CRE sheet. You will see that, and I will give you a sample of what a letter of intent looks like. I can tell you honestly that letter of intents are things that I'm using a lot right now because we are writing offers extensively. At least 2 offers we're pushing out on a weekly basis. And because of where the market is right now, we are losing deals left and right. And to see the numbers that people are asking for assets. For instance, we have a scenario where an asset was purchased last year, and that asset was purchased for $4.5 million. Today, they are asking $8 million for it, and guess what? They really didn't do any value add. They're just asking for $8 million because they can. Now, we're going to write an LOI and hope that we, can have a sanity check and a meeting of the minds, but we'll see where that goes and see if we can get a deal accepted. And, because you guys are on our list, if we were to get that deal accepted, we would share it with you if you wanted to participate. So the deal analysis, investor perspective, who is the lead sponsor and the track record? As I mentioned to you all before, and you hear me say it ad nauseum, there are certain things that we check in order to participate in a deal. And the first one is going to be the lead sponsor and their track record, right? The second thing is going to be the preferred rate. And we do not participate in deals if there isn't a preferred rate, because a deal that has a preferred return gives the cash flow distributions to the investors, the LPs, before the operators can pay themselves, right? We also look at cash on cash, looking at 9+ on the cash on cash. We're also looking at the internal rate of return and how it transitions based upon the operator meeting certain metrics. And the IRR that we like to start out with is at a floor of 16% IRR, which has been something that's been easy to meet over the last 3 to 4 years because there's been such demand for multifamily. And then the distribution hurdles are going to be there. It's better if you have a single distribution hurdle, because if you go with the 70-30 split and that rides all the way up, you as an LP investor gets to participate in that upside over the preferred distribution at a 70-30 split. However, because the property basically was able to perform through the intelligence and the work of the operator, some operators will say once we have a 20% IRR, we're going to change above 20%. The distribution will go to like a 60-40, or in most instances, you will see a 50-50 distribution split above that IRR hurdle, right? So that's the investor's perspective. The sponsor has to be concerned with what is the DSCR, which is the debt service coverage ratio. And we always want to see a debt service coverage ratio of at least 1.5, right? What the debt service coverage ratio says is how much, right, is available from a cash flow perspective after the debt is serviced, right? That number is 1. Well, one says that you have enough cash flow coming in, right? Most lending institutions will not go below 1.25. The higher it is over 1.25, the more security and the more you can believe that this asset is going to pay, right? If there are any issues with the asset. For instance, one of the assets that we are invested in, the Addison Oaks in Galveston, Texas, we had a fire at that property, and that property lost 24 units, completely burned. The asset, those two buildings have to be demolished. They've already been knocked down, and the pads are just there. Now, what happens with that, because there is a preferred return, right? The operator is not able to pay themselves, but they have had a hold on the distributions that they can actually share, because the bank, right, says, oh, let's hold on to all of the cash that we have, and we can't distribute that until we know how long, how much it's going to take to get these units back online. So they put a pause on all of our distributions, right? But the great thing about the multifamily syndication is the fact that that money is not lost, that distribution, because we weren't able, the property caught fire on January 31st. We had a scheduled distribution 15th. We weren't able to release those monies because the bank put a hold. The good thing about it is the distribution accrues until such time as the bank releases the hold, and we can distribute those funds. And we expect that to happen pretty soon, because we're through the insurance process as we speak. Now, what you see here as the sponsor's track record and the renovation business plan and business schedule, those are going to be very important, especially with value add. So if you were to go the route of a Class A asset, that's a brand new asset. Brand new assets probably can charge more from a rent perspective because they have certain luxuries and amenities. And they also don't have any deferred maintenance. So investors who are picking up Class A's are usually taking them from the developer, who then had to lease it up to a certain amount so that the investor can put some type of debt on it, right? And then they take that, have it for a couple of years, probably about 10 years before they sell it, and then it's a Class B asset. At that point in time, there might be a little bit of deferred maintenance, but we're typically picking up properties that are 20, 25 years old, and they need a renovation so that they can compete with those newer assets that are on the market, right? You also want to look at the type of expenses. When it comes to multifamily syndication, a property is going to run between 40 and 50% of net operating income, well, gross receipts, right? And the net operating income is going to tag out at about 60 to 50% of that. And then you want to look at the different streams of income. Of course, when it comes to multifamily, you're looking at the different ways that you're able to generate income. Now, rents, of course, are the primary way that you're going to generate income, but there are other opportunities that you can do, such as LA trash, right? You could do Wi-Fi in the community. You could do reserved parking in the community. You could do covered spaces in the community. You can implement in something that we often see implemented is something called a RUBS, which is a ratio utility billing system. That's where you're billing the tenants for the water and sewage that they're consuming. Rather than that being an expense on the apartment owner, that expense is now tied to the tenants, and that reduces the expenses on the operator. So those are some of the things that you're looking for, and also you're going to have to write in some type of vacancy and loss to lease. Just that always happen. I've been involved in now 23 syndications, and every single one of them I've yet to see. Well, one property, Atlantica, that just sold last month, and we got the distribution from that one. That was 100-unit complex, and there was one time when they sent us a report that stated that every single unit in that complex was occupied and tenants were paying. So it does happen. It's rare. Most of the time, a property is considered stabilized at around 92, 93%, right? But you know, it's rare that in a rare instance you will see a property that is at 90, 97, 98, 99. But also, that's going to be one of the reasons why when we look at our assumptions, we put it against the stress test to determine whether or not if that property would still be able to cover the debt service at like a 65% occupancy. So that's one of the things that you would want to ask an operator. Well, if you were to do a sensitivity analysis on this deal, would it still be able to cover debt service at 65% occupancy? And it should. And if it does, then that's an opportunity where you would want to invest. So what I'm sharing with you right now is a screenshot of the Michael Blank syndicated deal analyzer, and this is what we first started out using. And as you can see, I mentioned to you that the debt service coverage ratio has to be at about 1.55. And what Michael Blank has done with his sheet, he's color coded it so that you would know whether the deal starts to pencil the deal. So on this particular one, the AAR, which is just all of the revenues that, well, the returns that you've gotten divided by the number of years that you've had it, that should be 17%. So with this particular deal that was being underwritten at 6.4, it's a red flag. They're telling you that you shouldn't go. The same applies for the internal rate of return, which is a calculation that uses the discount rate, right? It's much better to use the IRR, in my opinion, because that calculates the time value of money and it goes over a number of years, right? So that one, the minimum that he's saying that you should use here is 15. We use 16, but this deal was penciling out at 6.5%. Red flag again, you don't want to go. Expenses are at 50%. This one was at 40%, which tells you that that's not a negative, but you probably want to look into it a little bit more, because typically expenses, as I mentioned just a little bit earlier, are at about 60%, right? And then there are a bunch of other metrics that are here, right? That you as the underwriter, as you're going through this, you're looking to this and you're making changes to the other summary tab, and you're making adjustments to see if this works, right? This is what I like about the Michael Blank syndicated deal analyzer, is it's really good if you're just coming into this. You can get a feel for it, but it doesn't at least the last time when I looked at it, it didn't count for waterfalls. It didn't account for different renovation schedules. Like you could have an S curve on a renovation schedule because you don't always come into a complex and immediately start making renovations, right? You're not going to, vacate the entire property, complete all of the renovations, and then rent it back up. To most likely be turning the property, doing a renovation at a unit whenever that property comes vacant. Whenever that unit becomes vacant, that's when you're going to turn it, get your crew in there, do the renovation. Once it's upgraded, then you're going to charge on the rent premium, right? You're going to go from a classic model to a renovated model, charge that rent premium, and then you're going to try to get that NOI going up higher. But all of this helps you to calculate all of this. And I think Michael Blank might be charging about $150 or $99 on sale if you wanted to download the syndicated deal analyzer, right, and use it for yourself. Here is the link to get to the syndicated deal analyzer if you wanted to underwrite on your own. But just the one reason why I share this with you is because we do this because we're investors first, right? We do this on every single deal where we're going to be investing capital in. We want to underwrite it to make sure that everything matches and lines up, right? The sheet that we create should match up with the old, and we should match up with the T12, etc. All of that needs to work out and make sense in our opinion. And if it doesn't, we pass on the opportunity and we wait for the next one to come through. I'm going to pause really quickly. Are there any questions that you guys have on this so far?
Good so far. Thank you.
Okay, I guess I have a question about the internal rate of return.
Yeah.
I guess I'm not exactly familiar with it, but is that kind of like revenue or so that's kind of related to revenue that you get from the investment?
Yeah, well, the internal rate of return, there's different ways that you're going to calculate it, right? Because you're going to be receiving cash flow distributions on a monthly and quarterly basis, right? So that's cash flow that you're getting. So that's a pot of money that you will have had, right? When the property actually sells, right, you will combine the net proceeds that you have above your basis plus cash flows that you receive. Based on your invested amount, you can then calculate what the IRR is going to be, right? So like, for instance, it was a 34-month hold for the property in Jacksonville. We invested $50,000. We got back, give or take, $74,000 in total. Like it was like $12,000 in cash flow distributions, right? Like $12,000 in cash flow distributions over the 34 months, right? And then we got another check for like 63 something odd dollars as well. So all of that then calculates for what the IRR is going to be. What you would do if you wanted to calculate the AAR is you would just take that full amount that you got and divide it by the number of years on the hold, right? That one doesn't calculate for inflation and things like that, because with IRR, you're calculating for the discount rate, right? Because the time value of money is there. That's why it's to me, it's a more precise number to use when you're thinking about a multi-year investment. The AAR doesn't take into account the time value of money. That's why for me, it's a less precise number. Does that help?
Okay, all right. And I guess when you refer to the time value of money, I think, are you referring to how money becomes like less valuable over time?
Yeah, a dollar today due to inflation is worth more than a dollar tomorrow, right? That's why that feeds into my concept that if I have if I have a deal where everything is equal, but one had a one had a monthly distribution and one had a quarterly distribution, I would take the everything equal, same IRR, same COC, right? I would take the monthly one because I have a system where I could then put that money back to work. Why should that money stay with the operator for 3 months, right? Usually it's a administrative thing, right? Right? Why should it stay with them when it could come to me and I could put it to work faster? But 3 months is okay. I definitely wouldn't go with a 6 month distribution or annual distribution. That's not going to work for me. All right. Okay, cool. So another tab, as I was mentioning it to you, is this is a tab where you're going to put in the different scenarios that you have, right? And as you start out, you look at the top, there's going to be the information that you've gotten from the mortgage broker. The commercial broker. They will have given you an OM or marketing package, and you would have put those numbers into your calculator, right? Now, you may not believe everything that they have told you, so then you would have your version, right? Like if the expenses are too high and different things, right? You might say, oh, well, I don't believe that. I don't believe vacancy is going to be 3%, and I'm going to version to have it at 5, right? The projected version is what you then take for if you were to increase the rents at 3% or 4% year over year, what is the income going to look like on that asset when you do increase the rents, right? The final piece is based upon all of this analysis that you have done, right? What would be the price that you believe that you can offer for the asset? Right? What is the price that you believe that you would be able to offer for the asset? Right? And that's the number that you go in with, and you then use that number to go and write up your LOI. Now, Michael Blank has a number of different tabs that are here, right? So there's the different scenarios that we're looking at right here, but Michael Blank also has on the syndicated deal analyzer a 10-minute offer. And a 10-minute offer just basically says, what's the NOI, what's the cap rate, this is how much the price should be. Just because you want to see if it's even worth looking at that area, because you as an underwriter, you're going to have your CoStar underwriting report that's going to help you to understand, well, what is the cap rate in that area. So you'll be able to look at the NOI, look at the underwriting report for that MSA, determine whether or not if it makes sense, and if the number that they're asking for is a number that you could actually bite off, right? So here you have a summary, you have a P&L, and you also have your acquisition costs and things of that sort. You see here, they were saying that the vacancy, this is from the OM now, the vacancy was at 5.2%, and the concessions, lost to lease, bad debt was at 2.4, right? In this version, what we had did is we had just said, you know what, it's not going to be 7, put it in at 10. And we took 10 across, and the offer was at a loss to lease of 5%, right? Down here is a very critical portion that you have here, is because in many counties, when the asset trades, there's going to be a bump up in the taxes, right? It's going to be a bump in the taxes. And this is the one that gets a lot of inexperienced syndicators, is that they didn't calculate into the model that the taxes were going to increase. But all is not lost when the taxes increase, because you can fight that tax increase with the county to say, oh no, it was calculated incorrectly. And you can go to debate with the county on that. is what the Michael Blank syndicated deal analyzer looks like so that you can have an understanding of it. And for the most part, as a multifamily investor who is working with an operator, you're going to want to look at all of this data so that it makes sense. Because as you see here, right, in scenario one, the debt service coverage ratio was at 1.4, right? But what we were able to do in the offer price, we were able to get it at a 1.55, right? And that then says to you that you should be able to have this deal cash flow if the debt service was to fall down to a certain level. I know that this is a lot, so I'm going to move on to the next slide and just give you an idea of some of the things that you're going to be looking for when you're there, right? And then there are certain other assumptions that you have here from a deal analysis perspective. And this is also some of the things that we have seen in the other spreadsheets that we've been using. And that's why we broke away from the Michael Blank one and we went on to other ones. Units that you're going to renovate per month, right? Michael Blanks didn't have that in here. How many units am I going to renovate per month? Because that's going to help to build out your model, right? So that you can be able to basically send this off to your lenders, right? And they will tell you whether or not if they believe your model makes sense, right? Also, you're able to see in the new spreadsheet that we're using, well, what is your break-even occupancy and how is that going to trend, right? Because you also have up here how many units you're going to renovate per month and the percentage of renovated at analysis start, right? So sometimes when you're purchasing an asset, some of the operators will have performed a certain number of renovations already, 10, 15, 20%. They have proven the business model to say that if you do renovate these units, these are the rent premiums that you'll be able to provide, right? So I like those deals as well where they have started it, but they didn't finish. So there's a little bit more meat on the bone, right? And you can come in and continue with those renovations and increase the rents just a little bit more. All right. But over here, right, in this spreadsheet that we're using now from Adventures in CRE, you get to also pull out, right, what's the GP? Who are the GPs? Who are the LPs? What's the acquisition fee going to be? What's the disposition fee going to be, right? Then you have the opportunity to put in different levels of preferred returns, right? Because what you're seeing now, they're saying if you're a class A, you get 9%, you get no split on the right? But if you go with a class B, you could get a 7%, right? And you get to participate on the upside, right? And there's all different kinds of distribution splits that are able, that help you to develop a different model, right? And then this is saying, well, this is how the GP split would be, GP net cash flow. Information is what you would need in order to be able to have that conversation with your brokers and with your investors, because some of them will want to, you know, get into the weeds and see all of this information because basically they want you to invest with them, right? So they should be willing to show you all of this data so that they can speak to it before you were to invest with them. The last one that I'm going to show you is that as you're doing your analysis, there are some rule of thumb type of numbers that you can use so that you can basically be able to calculate what your expenses are going to be, right? So, you know, real estate taxes is usually going to be about 0.01 of the sales tax. Now, this is an estimate. Some places it's going to be 0.02. Other places is going to, it wouldn't trade another game for another 3 years, right? Every 3 years is when they do an assessment. Every single city and county is different on the real estate taxes. And this is something that you need to underwrite, right? There are also estimates in here for electric, $100 per unit. Sewer and gas, if the sewer and water, $400 a unit, right? All of these numbers are going to be validated when you speak to your property manager, because you're going to ask your property manager for a budget, and the property manager is going to give you a budget of what they believe are going to be the expenses for managing the property, because they have all of this data for managing other assets in the same area. Then when you're doing your due diligence, you're going to come back into here and plug in those numbers to finalize this as you continue with your due diligence once you have your LOI accepted. So, all right, so let's pause right there before we go and start talking about what you would have to do before you LOI. Does all of this start to make sense as to why investing in multifamily syndication is a different beast than investing in single family rentals? There's a lot of numbers that are here, right? But this is what is necessary for you to take in if you're going to be a multifamily investor. This is right before we bring a deal to you. And this is one of the reasons why you guys haven't seen a deal from us since December, is because a lot of the deals, they haven't been penciling out just because of the change in the market, etc. But we do see a property that's in Winchester try to go for just the same. Any questions? All right. Thumbs up. We're going to move over to creating the LOI, right? So you get the contract. The LOI, when you first send it, is non-binding, right? What makes it LOI somewhat binding is when you turn over an earnest money deposit, right? You're going to have conditions on your LOI that state when does that earnest money deposit go hard. And when the earnest money goes hard, that means that it's not going to be returned to the buyer. Well, yeah, to the buyer if they don't perform, right? So remember, you're doing 1.5 up to 3% of the purchase price as an EMD. So it could be 100, 200, 300, $2 million in certain scenarios. So you got to be very careful with that. But once you have an acceptance, that's when you go in and you're about to spend some money, right? Because you have to do a financial document audit. You have to do an internal property condition assessment, right? A property condition assessment internally, a market survey, lease audits, unit walk. So if you have a 300 unit property, guess what? You're walking every single unit to determine what is wrong, well, what is the state of that unit, so that you can put together your budget, right, as you move into writing your PSA. Site surveys, your environmental site assessments, your appraisal, your green reports. All of these reports are going to be costing you money, right? That's why the operator, they're putting forward all of this money, right, as part of their risk capital so that they could secure the property and bring it back and try to, finalize the PSA. The PSA stands for the purchase and sell agreement. That's when all contingencies have expired, probably except for financing. But once you are working on your PSA, you have a valid binding contract and you need to go to closing. Now, some of the times you can't close in the date that you have prescribed, and you will have stated inside of your PSA what would be the condition for you to extend it, right? But usually that's going to come with another requirement for you to lay out some more money, right? And while you're doing all of this, remember, I always say, is that multifamily is a team sport, right? So while you're doing all of this, you are working with the banks or your mortgage brokers to try to get you the best type of debt that you can have, but you're also working with your equity investors, and you're raising that capital that you need to come to the closing table with. That's that 30%, 25, 30% that you have to put down, right, in order to close on the asset. So meanwhile, you're doing all of these different things, working with the bank, working with the equity investors, right, raising that capital that is going to be necessary while you're also performing your due diligence. And at this time, if you're going to be the asset manager, right, the asset manager is working with the property management company to make sure that that budget is solid, right? And they are coming to the agreement as to how they're going to run the property between the asset manager and the property manager. When I first started doing this, I thought that they were running the same, but I came to learn over my journey is that they are actually different individuals. All right. So once you have done all of that, right, you have it under contract, you get to the closing table. The next part of that is asset managing, right? Asset managing is where you are looking after the property and executing on the business plan until you can reach a point where the business plan is achieved, and then you can sell the property. And that's typically going to be 3 to 5 years into the hold is when you're going to be looking to sell the property, depending upon what the market is telling you, right? So guys, I know we went over quite a lot this evening. It is a lot to swallow. The best book where I have started with this, remember I've been doing this now since 2017, right, is the Joe Fairless book, The Best Ever Apartment Syndication book. That's a really good book. It goes over all of these different topics, and that's how we learned how to do this. We read the book, we did the Michael Blank course. We've just been continuing to educate ourselves on what this is all about. And you're probably saying, oh, Lee knows a lot. No, it took us a long, long, long time to get here. So are there any questions? Come on now, you got to have one question at least.
Yeah. Wait, so what is a green report?
Well, you have to do surveys to look at the land to determine, and this different terms for different people. But as I understand the green report, it's one of the reports that you're going to run to check the soil and everything like that to make sure that there aren't any contaminants in it. That's what I remember a green report is, but you could probably do your own Google search to determine whether or not if that's the definition for it still today. But you got to do environmental site surveys and all of these reports, and these reports are the ones that are actually going to start costing money, right? So initially, you say to yourself, well, how much? Why am I giving the operator any of these fees? This is why you're giving the operators these fees, is because they had to lay out a significant amount of capital to get the property on the contract. Then they have to work with the SEC attorney to develop the PPM. All of this costs money. And that's called risk capital that they're putting forward, because why you call it risk? Because there's a potential that all of these monies have been laid out, but the deal doesn't close. right? And if the deal doesn't close, they don't recoup any of that money, right? It's a loss to them, a cost of doing business, and they have to move forward. Does that work?
Yeah, that makes sense.
Mm-hmm. Hey Joe, you got anything?
No, not really. I just I missed the first two sessions, but I appreciate the walkthrough here. Just I assume that's the process you're working going through as you look at all the possibilities and generally getting some of those deals written up. So yeah, thanks.
No, I mixed up the environmental report, sorry, Dala, with the green report. And here it says a straightforward property analysis to show borrowers how they can save energy and water by making property improvement, right? So that's coming off of Fannie Mae. So I stand corrected. A green report is, and I was thinking that as well. The green report is actually going to be what happens if you were to implement low flush toilet bowls and showers, and what happens if you move to LED lights and things of that sort, right? So that's where the green report is going to help you. And the government actually has some type of grants and things of that sort that they share with you because they want you to be able to reduce your expenses as well. So there are all kinds of incentives that are tied around multifamily. And you guys know that I'm a big Tom Wheelwright fan in the tax-free wealth building. And that's what you do. The government wants you to do two things: provide jobs and provide housing. And they have so many tax incentives for you to do those two things that if you are an operator, it behooves you not to go and implement these types of systems. Okay. And at the end, if you have an operator who is well versed in all of these things, what they're going to do is they're going to be able to increase the NOI, which is then going to lead to an increase in the value of the property. So you want to work with an operator who understands these tax incentives and things of that sort, so that they can, get more out of that property than an operator who doesn't know these things. All right, guys.
Okay.
So, I always try to, you guys are my partners, right? That's how I named my company, Value Investment Partners, right? Here's my calendar if you want to meet up with me, or if you just want to have a conversation offline. You could text Meetup to me at 571-444-8474, or you can use the calendar to get my information. This is something that I believe was always better than having you to write down all my contact information, my email address, and all of these things. If you just scan that little calendar, to give you all of the information you need to know about me, Lee Johnson, and who I am and where I am and how to find me and get a hold of me. So right now, we're going to be moving our meetup to Wednesday. So it's going to be the last Wednesday of the month. So the next meetup is going to be on May 25th. Right now, I do not know what I'm going to speak about, but something that I'm going through and I'm taking my business through right now is I'm building out my business credit, right? And I think a lot of people, especially those who want to be in the single family in the flipping space, a lot of people are doing this under their personal financial credit profile. I think that that's a very bad thing, because if the business doesn't work, now you're personally in debt when you file for bankruptcy for the business. You don't want to do that. There's a proper system and proper way to fund your business by creating a business credit profile and then building up the credit profile so that you can take out loans, get credit cards, etc., in the name of the business versus in your own name. So that's something that I'm actively doing right now so that I can build up my lines of credit, etc., both vendor lines of credit as well as bank loans and lines of credit, so that I can, run my business and expand my business just the same. So that's where I'm leaning to talking about right now. But you guys can tell me something different. But I'll update the meetup with what the next topic is going to be so that you can definitely join us. So that's all that we have for today. I want to thank you for taking time out of your busy schedule. And I like to hold myself accountable to time, right? So we have planned for this to be a 1 hour meetup, and we are at 1 hour. Also look for us on the second Saturday is where I'm gonna find some place that has an outdoor venue so that we can meet in person, have a drink, and socialize with each other. But that's also going to be something that's coming up in the near future.